In this video, we will delve into the topic of hyperinflation and its potential ramifications on U.S. stocks and real estate markets. Hyperinflation, characterized by an extreme and rapid increase in prices, can significantly erode purchasing power and destabilize economies. Our purpose here is to explore various scenarios in which hyperinflation could impact asset values, particularly focusing on how it might affect investments in the stock market and real estate sector. Understanding these economic trends is crucial for investors, as they can provide insights into potential risks and opportunities. As we navigate through this discussion, we will highlight the importance of being aware of the broader economic landscape, especially in relation to the stability of the US dollar. As with all my videos, look in the description to find the sources used for the video. The dollar's role as a global reserve currency means that its strength or weakness can have far-reaching effects on international markets and investment strategies. By examining the implications of hyperinflation, we aim to equip viewers with the knowledge necessary to make informed decisions regarding their investments. The potential for hyperinflation raises critical questions about the future of asset values, and it is essential to consider how such economic shifts could influence market dynamics. The stability of the US dollar is particularly relevant in this context, as fluctuations can lead to significant changes in investor confidence and market behavior. By understanding the potential impacts of hyperinflation, investors can better prepare for the challenges that may arise and position themselves to capitalize on opportunities that may emerge in a volatile economic environment. Let's explore these scenarios and provide insights that can help you navigate the complexities of investing in a world where hyperinflation could become a reality. Hyperinflation is defined as an extremely high and typically accelerating rate of inflation, often exceeding 50% per month. This phenomenon results in a rapid decline in the purchasing power of a currency, leading to a situation where prices soar uncontrollably. Key characteristics of hyperinflation include a dramatic increase in the money supply, a collapse in the value of the currency, and widespread economic instability. Historical examples of hyperinflation provide critical insights into its effects and implications. One of the most notable instances occurred in the Weimar Republic of Germany during the early 1920s, where the government printed excessive amounts of money to pay reparations from World War I. This led to astronomical price increases, with people needing wheelbarrows full of cash just to buy basic necessities. Another significant case is Zimbabwe in the late 2000s, where hyperinflation reached an unimaginable rate of 89.7 sextillion% per month. The government's decision to print money to address economic challenges resulted in a complete collapse of the currency, rendering it virtually worthless. These historical examples illustrate how hyperinflation can lead to a profound loss of confidence in fiat currencies. As prices rise uncontrollably, consumers and investors begin to doubt the currency's ability to serve as a reliable store of value. This erosion of trust can prompt individuals to seek alternative forms of currency or assets, such as foreign currencies, gold, or other tangible goods, further exacerbating the decline of the fiat currency in question. The implications of hyperinflation extend beyond mere economic statistics. They can lead to social unrest, political instability, and a complete transformation of the financial landscape. Understanding hyperinflation and its historical context, particularly in relation to the US dollar, is essential for grasping the potential risks associated with fiat currencies. As we reflect on these past events, it becomes clear that maintaining confidence in a currency is crucial for economic stability, and hyperinflation serves as a stark reminder of the fragility of financial systems. The current strength of the US dollar plays a pivotal role in global trade and commodity pricing, serving as the world's primary reserve currency. This status allows the dollar to dominate international transactions, with many commodities, such as oil and gold, priced in dollars. As a result, countries around the globe require US dollars to engage in trade, which reinforces its significance in the global economy. The dollar's widespread acceptance facilitates smoother trade flows and provides a level of stability that is attractive to investors and governments alike. One of the key factors contributing to the dollar's stability is the network effect. As more countries and businesses use the dollar for trade, its value and reliability increase. This creates a self-reinforcing cycle where the more the dollar is used, the more it is trusted, leading to greater demand and further entrenching its position in the global financial system. Additionally, the U.S. economy's size and resilience, along with the liquidity of U.S. financial markets, bolster confidence in the dollar, making it a safe haven during times of economic uncertainty. However, despite its current strength, there are potential risks of currency devaluation in the future. Factors such as rising national debt, trade imbalances, and shifts in global economic power could undermine the dollar's dominance. If other countries begin to diversify their reserves away from the dollar, or if alternative currencies gain traction, the demand for the dollar could diminish, leading to a decline in its value. Furthermore, geopolitical tensions and economic policies that may lead to inflation could also pose threats to the dollar's stability. As we analyze the current strength of the US dollar, it is essential to remain vigilant about these risks. Understanding the dynamics of the dollar's role in global trade and the potential challenges it faces will help investors and policymakers navigate the complexities of the international financial landscape. The future of the dollar remains uncertain, and its ability to maintain its status as the world's leading currency will depend on various economic and geopolitical factors. Examining the effects of hyperinflation on the stock market and real estate values reveals complex dynamics that can significantly impact investors. Historical trends in countries like Zimbabwe and Venezuela illustrate how hyperinflation can lead to erratic stock market performance. In Zimbabwe, during the peak of hyperinflation in the late 2000s, the stock market initially appeared to thrive as companies adjusted their prices to keep pace with inflation. However, this was largely an illusion, as the underlying currency was rapidly losing value, leading to a disconnect between nominal stock prices and real purchasing power. Similarly, in Venezuela, while the stock market saw nominal gains, the reality was that these gains were overshadowed by the severe devaluation of the bolivar, rendering investments less valuable in practical terms. This phenomenon highlights the paradox of rising asset prices despite currency devaluation. While nominal prices may increase, the real value of those assets can diminish significantly. In hyperinflationary environments, investors often turn to tangible assets like real estate, which can retain value better than cash or currency. Real estate tends to be a more stable investment during periods of hyperinflation, as it is a physical asset that can appreciate in value over time. For instance, properties in hyperinflation-stricken countries may see their prices rise in nominal terms, as owners adjust rents and sale prices to reflect the inflationary environment. Additionally, real estate can provide a hedge against inflation, as rental income often increases alongside rising prices, allowing property owners to maintain their purchasing power. In some cases, real estate can even become a sought-after asset, as individuals and investors look for safe havens to protect their wealth. Examples from history show that while hyperinflation can wreak havoc on financial systems, real estate often emerges as a more resilient investment. Ultimately, understanding how hyperinflation affects stock market performance and real estate values is crucial for investors seeking to navigate these turbulent economic waters. By recognizing the historical trends and the inherent value of tangible assets, investors can better position themselves to weather the storm of hyperinflation. Protecting investments during hyperinflation requires strategic planning and a proactive approach to asset management. One of the primary recommendations is to avoid holding cash or bonds, as these assets tend to lose value rapidly in hyperinflationary environments. Cash becomes increasingly worthless as prices soar, while bonds, particularly those with fixed interest rates, fail to keep pace with rising inflation, leading to negative real returns. Instead, investors should consider reallocating their portfolios towards assets that have historically performed better during periods of hyperinflation. Real estate is often viewed as a reliable hedge against inflation, as property values and rental income typically rise in tandem with increasing prices. Investing in real estate not only provides a tangible asset but also generates cash flow, which can help preserve purchasing power. Additionally, stocks can serve as a potential hedge, particularly those of companies that can pass on rising costs to consumers, or operate in sectors that thrive during inflationary periods such as commodities or essential goods. These investments can help mitigate the adverse effects of hyperinflation on overall portfolio value. Furthermore, it is essential to consider alternative assets that may outperform traditional investments during hyperinflation. One such asset is Bitcoin, which has gained popularity as a mobile and scarce digital currency. Unlike fiat currencies, Bitcoin has a capped supply, making it less susceptible to devaluation through excessive money printing. Its decentralized nature allows for greater accessibility and portability, making it an attractive option for investors seeking to protect their wealth. As a digital asset, Bitcoin can also serve as a hedge against inflation, as its value is not directly tied to any government or central bank policies. By diversifying into real estate, stocks, and alternative assets like Bitcoin, investors can create a more resilient portfolio capable of weathering the storm of hyperinflation. Ultimately, the key to protecting investments during such turbulent economic times lies in understanding the risks associated with traditional assets and proactively seeking alternatives that can preserve and potentially grow wealth in the face of rising prices. Investing in stocks and real estate during periods of societal collapse carries significant risks that investors must carefully consider. one of the foremost concerns is the potential for government confiscation of assets during crises. In extreme situations, governments may resort to seizing private property or imposing heavy regulations to stabilize the economy or maintain control. This risk can be particularly pronounced in countries experiencing political upheaval or economic distress, where the rule of law may be weakened and property rights are not guaranteed. Investors must remain vigilant about the political landscape and understand that their assets could be vulnerable to state intervention in times of crisis. Additionally, protecting property rights in unstable environments presents considerable challenges. In regions where societal collapse occurs, the legal framework that typically safeguards ownership may become ineffective or non-existent. This can lead to disputes over property ownership, increased crime rates, and a lack of enforcement for contracts and agreements. As a result, real estate investments may become precarious, as the value of properties can plummet due to insecurity and the inability to enforce legal rights. Investors may find themselves unable to sell or rent properties, further exacerbating financial losses. Moreover, understanding the fundamentals of different asset classes is crucial when navigating investments during societal collapse. Stocks and real estate can behave differently under stress, and their performance may be influenced by various factors, including market sentiment, liquidity, and economic conditions. For instance, while real estate may provide a tangible asset, its value can be significantly impacted by local conditions, such as crime or infrastructure deterioration. Conversely, stocks may experience volatility as investors react to news and events, leading to rapid price fluctuations. Therefore, a thorough understanding of the underlying fundamentals of each asset class is essential for making informed investment decisions. While stocks and real estate can offer opportunities for growth, the risks associated with investing during societal collapse are substantial. Investors must be aware of the potential for government confiscation, the challenges of protecting property rights, and the importance of understanding the fundamentals of their investments. By recognizing these risks, investors can better prepare themselves to navigate the complexities of investing in uncertain times. In a hyperinflationary context, Bitcoin presents unique advantages that make it a valuable asset for investors seeking to protect their wealth from currency devaluation. One of Bitcoin's most significant properties is its scarcity. With a capped supply of 21 million coins, it is immune to the inflationary pressures that plague fiat currencies. Unlike traditional currencies, which can be printed in unlimited quantities by central banks, Bitcoin's fixed supply ensures that it retains its value over time, making it an attractive option for those looking to hedge against hyperinflation. Additionally, Bitcoin offers unparalleled mobility and censorship resistance compared to traditional assets. Transactions can be conducted quickly and easily across borders without the need for intermediaries, such as banks or financial institutions. This mobility allows individuals to access their funds and transfer value seamlessly, even in times of economic turmoil. In contrast, traditional assets may be subject to restrictions, capital controls, or bureaucratic delays, making it difficult for investors to move their wealth when they need it most. Furthermore, Bitcoin's decentralized nature means that it is resistant to censorship. No government or authority can freeze or seize an individual's Bitcoin holdings, providing a level of security that is often lacking with conventional assets. Real-world examples illustrate Bitcoin's utility in crisis situations. During Venezuela's hyperinflation crisis, where the bolivar lost significant value, many citizens turned to Bitcoin as a means of preserving their wealth. Reports indicated that Venezuelans were using Bitcoin to conduct transactions and store value, as it provided a more stable alternative to their rapidly devaluing currency. Similarly, in countries like Zimbabwe, where hyperinflation rendered the local currency nearly worthless, Bitcoin emerged as a viable option for individuals seeking to protect their savings and engage in commerce. Bitcoin's unique properties, including its scarcity, mobility, and censorship resistance, position it as a valuable asset during hyperinflationary periods. By offering a means to preserve wealth and conduct transactions without the constraints of traditional financial systems, Bitcoin has proven its worth in real-world crisis situations. As investors seek alternatives to safeguard their assets, understanding the advantages of Bitcoin in a hyperinflationary context becomes increasingly important. In this video, we have explored the multifaceted impact of hyperinflation on various asset classes, including stocks, real estate, and Bitcoin. We discussed how hyperinflation can lead to significant volatility in the stock market, often resulting in nominal gains that do not translate into real wealth due to currency devaluation. Real estate, while generally seen as a more stable investment during inflationary periods, also faces risks related to government intervention and the protection of property rights in unstable environments. On the other hand, Bitcoin emerges as a unique asset in this context, offering scarcity, mobility, and censorship resistance, making it an attractive option for those looking to preserve their wealth during times of economic turmoil. As we wrap up, we encourage you to engage with our content. If you found the insights shared in this video valuable, please consider subscribing to the channel, liking the video, and sharing it with others who may benefit from this information. Your support helps me create more content that dives deep into important financial topics. Whether it's strategies for protecting your investments during crises or the fundamentals of different asset classes, there's a wealth of knowledge to uncover. Please feel free to ask questions or share your thoughts in the comments section below. I look forward to continuing this conversation and providing you with more insights that can help you navigate the complexities of investing in today's economic landscape. Stay tuned for my next video, where we will delve deeper into these topics and more.